Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of the complete guide to stock market analysis for smarter investing. Assessing company financial statements. Financial statements are like the heartbeat of a company. To truly understand what's going on under the hood, you'll want to dive into 3 key reports: the balance sheet, income statement, and cash flow statement. Let's break these down. Balance sheet. This is where you'll find what a company owns, assets, and what it owes, liabilities. The difference between the two is equity, often referred to as the net worth of the business. Look for solid assets compared to liabilities. A growing equity value generally means the company is in good shape. Income statement. Sometimes called the profit and loss (P&L) statement, this report shows how much money the company made, revenue, and spent, expenses, over a specific period. Pay attention to profit margins here: gross, operating, and net. Consistent or growing profits mean the business is likely doing something right. Cash flow statement. Profit can look good on paper, but is the company actually generating cash? The cash flow statement shows money moving in and out. Positive operating cash flow is crucial because it means the company can cover its daily expenses without relying on external funding. Interpreting these documents might feel overwhelming at first, but think of it like learning to read a map. Over time, spotting trends like rising revenue, manageable debt, and stable cash flow will become second nature. Industry and economic analysis. A great company isn't always a good investment. Why? Because broader industry trends and economic factors play a significant role in how well it performs. You don't invest in isolation, you're always part of a bigger picture. Industry trends. Is the company in a growing or shrinking industry? For example, tech and renewable energy are expanding rapidly, while industries like coal may be on the decline. Research competitors, market share, and innovation within the industry to see how the company stacks up. Macroeconomic factors. Interest rates, inflation, and GDP growth can all impact a company's bottom line. Let's say interest rates rise. This might hurt businesses with high debt because borrowing becomes more expensive. On the flip side, a booming economy can drive consumer spending, benefiting many sectors. Regulatory environment. Keep an eye on government policies and regulations. For example, stricter environmental laws might increase costs for traditional energy companies, while benefiting green tech firms. By combining company-specific data with industry and economic insights, you set yourself up for a clearer understanding of where the business is headed. After all, you wouldn't judge a fish on its ability to climb a tree. Context matters. Technical analysis. When it comes to understanding stock price movements, technical analysis is all about patterns, trends, and data. It focuses on analyzing historical price charts and market statistics to predict future behavior. Think of it as studying footprints on a trail. You're not asking where the hiker is heading or why they're walking, but their steps reveal clues about the path ahead. Analyzing stock charts. Stock charts are the backbone of technical analysis. By visually plotting a stock's price movements over time, charts provide valuable insight into trends, momentum, and potential reversals. There are several types of charts used by investors, each with a unique focus. Line charts. Simple and straightforward, line charts connect closing prices over a period, forming a continuous line. These are great for identifying broad trends but can miss details about intraday price movement. Candlestick charts. A favorite among traders, candlestick charts offer a deeper look at price action. Each candle represents a specified time frame, e.g., 1 day, and shows the opening, closing, high, and low prices. The color of the candle indicates whether the price rose, often green, or fell, often red. These charts provide clear visuals of market sentiment and potential reversals. Bar charts. Bar charts are similar to candlesticks but present the same data in a simpler format. Each bar represents the high, low, opening, and closing prices for a given period, ideal for spotting price ranges and volatility. Understanding these charts is the first step to interpreting market movements. Like reading a roadmap, knowing what each line or bar represents will clarify the bigger picture. Understanding technical indicators. Once you've mastered reading charts, the next step involves adding technical indicators to your toolkit. These indicators use formulas and statistics to provide deeper insights into a stock's performance, helping you spot trends and make informed trades. Some of the most commonly used technical indicators include moving averages, MA. These smooth out price data to highlight trends by averaging past prices over a set period, e.g., 50-day or 200-day. If the current price is above the moving average, it signals an uptrend. If below, a downtrend. Relative Strength Index, RSI. RSI measures momentum by comparing the magnitude of recent gains to losses. It's scaled from 0 to 100, with readings above 70 indicating overbought conditions, potential sell signals, and below 30 indicating oversold conditions, potential buy signals. Moving Average Convergence Divergence, MACD. MACD reveals changes in momentum and trend strength by comparing two moving averages. The crossing of signal lines can indicate potential buy or sell opportunities. Volume Analysis. Volume tracks the number of shares traded during a given time. High volume during price increases can confirm an uptrend, while low volume may signal a lack of conviction behind a move. Each indicator tells part of the story. Using them together helps paint a complete picture of where the stock might be headed next. However, no single indicator should dictate your decisions. Combine them for better accuracy. The psychology behind technical analysis. At its core, technical analysis is just as much about human behavior as it is about numbers. Chart patterns and indicators reflect the emotions of market participants: fear, greed, optimism, and panic. Understanding this psychological aspect can give you a significant edge. Here's how market psychology ties into technical analysis. Market sentiment. Stock prices often move due to collective emotions rather than facts. For instance, in a bull market, optimism can push prices higher even if there's no solid reason for the rally. Conversely, fear in a bearish market can drive prices lower than they're fundamentally worth. Indicators like RSI and volume can help identify when sentiment is reaching extreme levels, signaling potential reversals. Trends. Trends happen because people tend to follow the crowd. If a stock starts climbing, more buyers will jump in, fueling the trend further. Trend-following techniques, like moving averages, capitalize on this behavior. To put it plainly, trends reflect the herd mentality of investors chasing gains or fleeing losses. Patterns in behavior. Repeating price patterns, like head and shoulders or double bottoms, emerge because investor reactions to certain situations, e.g., resistance or support levels, tend to be predictable. These patterns are like blueprints of historical behavior, giving clues about possible future moves. By studying the psychology behind technical analysis, you don't just see the data, you understand the emotions and decisions that drive it. This insight can help you anticipate market movements, not just react to them. In short, technical analysis blends hard data with human behavior, offering a practical way to predict price movements. It's not a crystal ball, but for traders focused on the short term, it's an invaluable compass. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.